Hey, this is Kevin Cumbus, president of TUSK Partners. Really wanted to pull together a presentation for you all about unsolicited offers and the concepts around doing a deal yourself. Because if you are a large, growing practice or an established group, undoubtedly you have received an unsolicited offer in the last year, quarter, month, week, or even as soon as yesterday. So wanted to take a couple minutes of your time to walk you through what we're seeing in the market and how to respond and react to these trends. Just briefly about TUSK, we 8 team members here. We've closed over $600 million of transactions. Many of those clients come to us with an offer in hand. So over the 150 dental practice transitions we have done, we've been able to greatly improve the offer that the client comes to us with. TUSK is really about the people inside of the organization. And what I love about our team is that we are really the perfect marriage between finance and investment banking, private equity, and dental, and a passion around dental, DSOs, and healthcare. The brands you see on this page are all of the companies that team members inside of TUSK have worked for leading up to their engagement in working with TUSK. So we have a passion around value creation for each and every one of our clients. All right, so it is no secret that unsolicited offers are everywhere. You may have a stack of them sitting on the corner of your desk right now, or your inbox may be littered with them. The reality is DSOs are spending millions and millions of dollars each and every year in direct mail, pay-per-click, hopping in airplanes, buying red meat, red wine, you name it, to woo each and every one of you in the hopes that you will sell your business to them without taking it to market. What they don't want you to know is that those who have worked with us and came to us with an unsolicited offer in hand, on average, are receiving about 41% more in the sale of their business than if they would have gone ahead and accepted that offer. Look, we got great friends in this industry. We need the buyers out there, but it is no secret we end up costing them money. So there are 5 things we want to cover today on this presentation. And if you're going to do a deal yourself, and there are lots out there who do, and we're going to share some statistics about that in a minute. There's certain things you need to know before you head down that pathway. So we'll tick through the agenda quickly and then dig right into the content. 1, private equity groups and DSOs are in this for the money. They are capitalists. It is not a dirty word. They make their money by buying low and selling high. Number 2, they want to buy you when your business is not prepared for a sale. They don't want you to window dress it. They don't want you to clean up the numbers. They don't want you to really put your foot down on the accelerator and build the biggest revenue and EBITDA you can in preparation of the exit. They want to catch you when you're not thinking about that. Number 3, they control the speed, information flow, and process of the deal when they're the only buyer, not you. If they control the process, you're at a disadvantage right out of the gate. Number 4, they want you to focus on the price or the multiple and not the structure of this transaction. We always hear, I got 10x for my deal. I got this many millions of dollars for my deal. And I ask them, how was the deal structured? And they kind of shy away when people get asked that question. Structure matters as much or more than valuation. Number 5, if you have seen one DSO offer, you have only seen one DSO offer. Every DSO we work with, every buyer we work with has a unique structure and has unique equity pools and has unique cash flows attached to it. So I think our clients are amazed at the variability of offers out there. And we're going to give you some examples of that today. All right, so let's dig right into it. Private equity groups and DSOs are in it for the money. And the reality is they hate it when we get involved because we end up costing them more money. Look, they like the fact that we bring a sense of order to it. They like the fact that we build nice virtual data rooms. They like the fact that we've done a lot of the homework and getting the adjusted EBITDA correct, because they know that our numbers are going to fly through the quality of earnings process, and there's going to be very little haggling and back and forth around the EBITDA, and our deals are going to get closed. But they certainly admit that it's going to cost them more money. So we did a little study on this. We went out and we asked 3 of the largest acquirers in the DSO space, what percentage of the deals that you closed in the last year had brokers or advisors working for the seller? This is not just TUSK. These are advisors nationwide. It could be a local broker. It could be an M&A advisor. It could be a large investment bank, a bulge bracket investment bank. But we wanted to know what percentage of the deals that they closed had representation. One of the largest acquirers out there said 26% of their deals were represented by an M&A advisor. Another top 5 acquirer in the nation said only 17% were represented by an M&A advisor. And the group who buys the most practices each and every year, historically for the last 3 years, said that only 1% of their deals are represented by an M&A advisor. They don't like it when folks like us get involved. They prefer to go and find the doctor who is not fully aware of what their business value is, who may not fully understand what EBITDA means or what a multiple is. Now, if they're taking advantage of anyone because they're able to get deals closed. But at the same time, this is a very telling statistic that they would prefer to kind of do only deals that are not marketed. So we asked them a follow-up question: would you expect to pay a premium when bidding on a marketed transaction? 100% of them said yes, no questions asked. So now let's put ourselves in their shoes, right? So these are buyers that are private equity backed, that are out there trying to buy businesses every day and taking great pride in doing deals that are not represented by M&A advisors. So we asked them, we kind of surveyed the market, said, let's look back and see how many DSOs that were private equity backed sold without an M&A advisor in some capacity over the last 5 years. Guys, it's none of them. So what they are doing in the market, what they're asking doctors to do, sell without representation, none of them would ever do. None of them. Again, why? Because the name of the game here is buy low and sell high. Buy low from someone who's not represented, sell high through representation. If you do decide to go with this alone, here's what they know that they may not reveal to you. Yes, you're both capitalists. Fantastic. You're the business owner. They also know you're emotionally attached to the business and that you have one business to sell. They, on the other hand, have a huge team of people that are working on getting your transaction closed. Yeah, there's the C-suite, there's a business development team. There are a lot of MBAs and PE guys and CPAs and attorneys and you name it. But really, although you're only working with one individual, likely, maybe it's the business development guy who flew in and took you out to dinner, and you feel like that's your liaison, behind that individual is a team of people who are regularly having check-in meetings, checking in on your deal to make sure that they can get that deal closed at the lowest possible price. They're financially incented to do so because that business development person likely owns equity in the business that they are working for and is financially incented through their equity to buy at the lowest possible price, because ultimately when they sell, that arbitrage between what they bought you for and what they sell is how they're going to make all that money in their stock. All right, number 2, they want to buy your business when it is not prepared for a sale. Look, I'll tell you a story. So one of the hottest real estate markets the U.S. has ever seen, and I actually recently went through a sale of my home. This is not a picture of my home, for those of you wondering at home, but it doesn't look too dissimilar from this. I could have absolutely sold my home for sale by owner. I chose not to, though, because I wanted to lean on an expert to help me maximize the value, not make it such a burden on me and my family, but also help me prepare my home for sale so it's shown in the brightest light. So, let's say this is where we started, this is where we end up. It's clear to me, and I'm sure to everyone on the call, which one's going to sell at a higher price. We do the same things with our clients. So what we do is we work really hard to prepare the business for sale to maximize the value. Buyers, on the other hand, are not interested in you doing that. They know that your business is always in motion, right? You've got de novos coming out of the ground. You've got associates coming and leaving. You may have a pipeline for additional M&A activity. There could still be some lingering COVID impacts in your business, on and on and on. So as a business is always in motion, buyers will use those activities as opportunities to decrease the value that they're willing to pay or the price that they're willing to pay. And working with an M&A advisor like TUSK, what we're able to do is really understand those fluctuations inside of your business over time, get a handle on where the business is going in the future, and craft a story that's irresistible to the market, that explains all that noise that exists inside of your practice in every business in America, right? So we really help you window dress that business for the market because we know which one's going to sell for more. Number 3, they control the speed of information flow and process, not you. Those who control the speed, the pace, and the cadence of the deal, they are the ones in charge. They're the ones who are learning about your business and kind of, frankly, leaving you in the dark. If this is sounding too familiar to you and you're like, oh my gosh, I'm like already in this process. I am 3 steps down the pathway and I need help. You can reach out to us and we will help you. So feel free to reach out to us directly. Go to our website, fill out the contact form. You can call our office. We are here to help you. So if this sounds like you, don't worry, we're here to help. So let me give you an infographic because I think this is a really nifty way to kind of share what's going on during a buyer's discovery process of you, the target. And I think the language here is really important. Target, that is what you are. You are a target of their acquisition team. And they know a little bit about you when they get started, only what's publicly available. And the buyer makes it their job to shrink the information gap that they have about your business. Now, you have an information gap about their business as well. And you have to know the right questions to ask to begin to shrink that gap. But if you've ever been on the call with one of these BD guys or a private equity guy, you'll notice that the questions are like machine guns coming at you. It's one question after the other, and there's not a lot of airtime for you in turn to ask questions of them. This is not a coincidence. We hear it all the time, and it is by design. They are trying to shrink the information gap that they have about your business so they can make an informed investment decision about the risk that lives inside of your business. So as the process continues, what's going on is they're asking questions and learning non-public information about your business. They've asked you about your financials. You probably provided them, operational information, doctor turnover information, payer information. You're continually giving in this because what you really want to know is, well, I wonder what offer they're going to put on it. I wonder what they're going to offer me. They're also probably asking you, what sounds good to you? What would a good deal be for you? And they're filing all that information away in a file for you. So while they're getting smarter and smarter about your business, all you may be doing is calling around and asking calling their references and learning about their experience in the business, but not a lot of knowledge gap is shrinking on your side. It's really shrinking on their side. So by the time they are prepared to put a bid in, they've not only analyzed your business, but they've looked at all the synergistic upside and opportunities that live inside of your business for them. And you're sitting there waiting for the offer. When we work with clients, it is a vastly different experience. First of all, the target becomes a client. And when the buyer knows that you're working with us, the tenor and tone of the conversation changes because they know that they must compete to win the deal. And they recognize that they're on equal footing with a whole host of other buyers, and that they don't just win on economics, they have to win on culture, value the equity, fit, and the economics. And in working with our client's knowledge grows, and that gap that used to be so large is shrunk. That's not just a knowledge gap for that one specific buyer, though. It's the knowledge gap that shrunk about the entire buy side. Because when we work with groups that have unsolicited offers in hand, we're going to take them out to a broader group and make sure that they know all the buyers that are available to them. I mean, the way I view this is you get one chance to sell your life's work, and you should leave no stone unturned when it comes to who the right partner might be. Remember, all these deals required post-sale employment agreements. So you're going to be working with and for this group in some capacity going forward. So I just want to make sure it's really kind of our mission here to make sure that it's not just maximizing the value. I have no doubt we're going to do that, but that you're happy with the decision culturally and operationally and clinically 12, 24, and 36 months after the transaction has been consummated. Okay, next topic. They want you focus on the price or the multiple, not the structure or the culture. Remember, the structure is where the value lives in these deals, and the culture is where you live post-close. How many times have you been to a DSO conference to hear guys talk about, oh, I got this multiple or that multiple or this many millions of dollars for my deal? And then I like to ask them, like, well, what was the deal structure, and how's the earnout coming, and what's your post-sale employment agreement? And I'm always a little surprised when I don't get the same energy around structure as I do around valuation. Man, I'll tell you right now, if you want to sell your business to me for 20 times EBITDA, I will buy it for that multiple if you let me structure the deal. And you can go to every DSO conference and tell everybody you sold for 20 times. That's how valuable structure is in these deals. So let's kind of peel back the layers of this a little bit. All right, so they're courting you, you're spending time with them, and the offer finally comes in. Any of you who've seen a letter of intent know that it's probably a 5 to 10 page document, and in big bold letters, it's that offer price. And there's a lot more to that document than just the offer price. And there's a lot of places where hiccups can occur. So the tip of the iceberg, what you see above the waterline, is that offer price 10 times. But it likely includes the opportunity for clawbacks or retrades or earnouts, their termination rights with respect to your employment, which, by the way, are linked to your equity, their non-compete radiuses for you, your associates, your team. There can be equity dilution depending on how they continue to buy additional practice. There can be preferred securities that live inside of these deals for private equity groups to where they get paid long before you get paid. They can take management fees that are unclear to you to begin with. There could be buyer illiquidity where the lender isn't ready to step up and make that next acquisition, and not growing through acquisitions can be a terminable event to a DSO. You may not know the quality of the buyer's equity, the quality of the leadership inside of that business, with their reputation, not just inside of your state, but inside of the nation. These deals are wrought with peril, and we make it our job to understand everything below the waterline so our clients don't have to worry about that. So if you don't know all this stuff, it's not surprising. Don't beat yourself up. Many don't. And that's the hope of some out there providing unsolicited offers to owners of individual practices and groups like yours. So let's look at how a deal might be portrayed, looking across 5 quantitative and qualitative factors. On the left-hand side of this graph, what you see is price, culture, value of equity, reputation of the DSO or private equity group, and experience of the DSO or private equity group. Let's define those real quickly. Price is just that, total enterprise value. Culture could be cultural fit, Value of the equity is the likelihood of that equity turning into cash at some period of time at some reasonable return on invested dollar. The reputation of the DSO or private equity group speaks for itself, as does the experience. This experience piece, I think, is extremely important as we are seeing newly formed private equity-backed DSOs on close to a weekly basis right now. There are going to be more private equity-backed DSOs in the history of our economy at the end of this year. We have personally helped connect 3 new private equity groups to DSOs in the last couple of months, and we're proud of that work. But one thing that you will know and you will learn over time is not all private equity groups are created equally as well. And some of them are experts in manufacturing, experts in automobiles, experts in car washes, but have zero experience around healthcare services, much less the business of dentistry. And we're seeing more and more of these private equity groups that have an interest getting involved in the space, investing, and really not knowing what they're getting themselves into. And I think we're going to see, a lot of this come home to roost in the weeks and months to come. Okay, we understand the graph across the top is pathetic on the left-hand side, average right there in the middle, and then enviable on the far right. Hell, that's where I'd want to be. I don't want to be on the enviable side. Offer comes in, this unsolicited deal, and all you see is the price. And you're like, man, this looks good. It's an enviable price. I feel really good about it. But what we know is culturally, there's probably not a great fit. The equity, it's never going to get there. The reputation of the DSO is not good because we know from others that they've had a top-down approach to clinical care. We've seen massive turnover with the doctor leadership over recent months, and the experience of the DSO of the private equity group is starting to show. They think you can squeeze profitability out of doctors by replacing them. I mean, this is an offer that we've seen. High price, garbage on the rest of the equation. In working with us, what we might be able to bring is a couple different options, right? Could be a slightly lower price, but higher on every other facet. But what we've done typically and most recently is bring deals that are much higher in price and varied across cultural value of equity, reputation, and experience. The good news is we bring a lot of offers to every group we work with and really help them navigate that space to find the right partner at the right price for their deal. One quick note on equity. Everybody's going to tell you that their equity is going to do this, they're going to do that. We have the experience to have a pretty clear crystal ball about what the future looks like and can point you to successful equity exits over time. If anyone out there is telling you that they're going to get you a 10x return on your equity, meaning $1 invested is going to certainly turn into $10 on the exit, they don't know what they're doing. We haven't seen it. With the highest returns we've seen are somewhere between 7 to 8, maybe touching 9 times, but that's really a unicorn style deal. Where you get in matters. So if you're early on getting in on one of these deals, like this DSO1, getting in at $1 a share and seeing that share price at exit go up to 7, that would be a 7x return on your rolled equity. What's a lot more common is to see a share price of $1 turn to about 3. And look, candidly, what we have seen as well is see a share price purchase of just south of 5 and see that share price roll up to 5 for a close to meaningless return for the risk that you've taken on. We make it our job to understand how you're getting into and out of these structures. They are not intuitive, and everyone does it a little bit differently. And this is a massive opportunity for some wiggle room, for some unscrupulous activity. So just if you're doing your deal on your own, pay extremely close attention to this. If you're hearing things, you're like, oh my God, I'm talking about the equity now. I'm like again 3-4 steps down the path, and you want a second opinion and you want some help. Feel free to reach out to us. We are here to help you. Look, we want to really shrink the information asymmetry gap and help you maximize the value of your life's work. This stuff is complicated, so the more we can do to help you get smart on it, the better off we are, the better off you are. And it just drives more value for everyone involved. Okay, finally, in the DIY, do-it-yourself deal, the last thing you need to know is that if you have seen one offer from a DSO, you've only seen that one offer. You've heard this old adage, if you've seen one DSO, you've seen one DSO, the offers are the same. Every buyer we work with comes to the table with differing structures. They have a standard allocation of proceeds, allocation of enterprise value between cash and equity. They have a standard place where they want that equity to live. Maybe it's exclusively at the DSO level or exclusively at the practice level. And that some of that equity may come along with distribution rights, right? Distributions to shareholders, others don't. Some by AR, some do not. Some want to pay you 30% of collections as a provider. Some want to pay you 25% of production, less labs. Oh, by the way, that should drive your EBITDA on and on and on, right? So if you got one offer in your hand, heck, if you got 3 offers in your hand and you're trying to understand them and sift through them, the reality is there's 10 more you haven't seen, 15 you haven't seen that could really fit the bill for you from a economic, operational, and emotional perspective. So the offer you have is great, but we just want to make sure everyone knows there is a lot of other offers out there. I'm going to quickly show you a slide here. I know this is hard to see, but I just want to give you a sense of what we work through in every deal. This is a client who had an unsolicited offer. Deal came in, and ultimately the deal didn't get done, which is a heartache because they sunk all that time, energy, money into it. They came back to us, and we were able to bring them some remarkable offers, deals, just a sweetheart deal for everybody involved. Here's the thing. The economics are up top, and they're really, really interesting, but it's all these quantitative and qualitative aspects of the deal that I want you to see. This is how we score each and every deal, and you can truly see that the devil is in the details of each and every one of these things. So that's the details, but this is the cash flow. Those letters of intent that you have in your hands or you have on your desk stacked up on the left corner there that you keep looking at and wondering, well, maybe I should sell my practice. What they don't show you are the expected cash flows over time. This is a challenge to build, and it takes a lot of work, but we think it's absolutely worth it. So our clients can see with a high degree of certainty what the likely financial outcomes would be based on our experience over time. And what I find so interesting about this graph in particular is you start at year 1 and there's a rather tight band, and by the time you roll out to the total final post 7 years of transactional cash flows, the gap is huge. Right? It's almost from $20 million to $45 million of total transactional value. Oh, by the way, all the enterprise values are kind of in a tight band, and the cash at close is relatively in a tight band. So this is all driven by structure, not value, not what am I willing to pay you today, what's your enterprise value, what's your multiple. It's all driven by structure. So the devil's in the details here. You don't know which one you have. Heck, you could have this light gray one, or you could have this, relatively, dark blue one, but you don't know until you have other offers to compare it against. And that's the big issue. That's the concern. And that's the worry that I have for those of you who decided to do the deal on your own and think you have a great deal, because it might scratch every itch that you have. They might have met every need and every ask that you've asked for, but you don't know what else is out there. When I had a broker sell my home, it's a relatively straightforward transaction, right? I've got an asset. We're going to pretty it up. We're going to take it to market, and we're just going to accept the highest dollar amount because that's the way these deals work. That's the way real estate works. It is not the way a sale of a business works. There is so much more to consider, so much more around structuring, post-sale employment agreement. Top offer many times doesn't win. It's structure that wins the day. So just a couple of case studies. Earlier we flashed a number, 41%. So of the deals that come to us, of the clients who come to us with an unsolicited offer in hand, we're able to increase their offers pretty sizably. So here are 3 case studies of that. Dr. Amy Jackson, she received a 63% improvement over her unsolicited offer. Fairfax Oral Surgery, almost 100% from the offer they received. And then Dr. William Bennett of Foundations received a 45% improvement over his unsolicited offer. Look, it's real, right? You're going to get a sizable return on investment when you decide to engage us. And look, that we're all aligned on that front. Again, this is what's going on in the market, and we want to make sure everyone was aware, because what you're being offered right now is a grape. Okay, you can have 100% of your grape and enjoy it. It's probably a one biter, or you can work with us, and we can get you close to 90% of watermelon. And my guess is all you out there would want, and in my opinion, deserve that 90% of a watermelon. So if you want a 41% improvement on your unsolicited offer, you need to reach out to us. You can find us at tusk-partners.com. Reach out directly to Maggie Jarrett, Director of Business Development here at TUSK. There's her email and phone number. I love having Maggie on our team because she switched sides. She was on the buy side as a private equity investor and is now sharing with us and all of our clients, what the way buyers think about this. I mean, they used to track how many deals they could close that were not marketed and represented by a broker. She believes in the mission. She has the passion to support it. So if you've got questions, feel free to reach out to her. She would be more than happy to take your call. Thanks for your time. We look forward to fielding questions. And as always, have a great day and best of luck to you all on your business journey.